This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Need help in finding investors for your startup, fund, or angel group? 10 Capital provides funding as a service helping you find accredited investors. Contact 10 Capital to gain access to investors for angel and venture capital funds, family office rounds, and syndication raises. To learn more, go to 10capital.group. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Tim Marx, venture partner at Baird Capital. Baird Capital makes venture capital, growth equity, and private equity investments in strategically targeted sectors globally. Since 1989, they have raised and managed more than $3.8 billion and invested in over 320 portfolio companies. Tim, thank you for joining us.
Thank you, Hall. Pleasure to be here.
Great. So tell us more about your background. What did you do before you started investing in early stage companies?
Sure, sounds good. Well, upon completing college, I got a Fulbright scholarship, and that took me to Mexico, where I was working in banking for a year. And the idea was to come home after 10 months and look for a job in New York or Philadelphia, where I'm from. I met someone at the time, and my girlfriend at the time, well, now wife of 16 and a half years, so decided to stay. Looked for a job, received a job offer at BCG, and with the exception of business school, wound up spending almost 17 years as a consultant before leaving as a partner and managing director. Now, and the reason I did this was to focus on smaller, more innovative companies, which is where I realized I had a passion. As for Houston, where I live now, I had done a lot of traveling internationally to South America, Europe, lived in a couple different countries. But one of the places I used to have to come quite a bit was Houston, in fact. And we thought it's not too far from Monterrey, Mexico, where we were living, and figured we'd give it a shot, and we're very happy here.
Great. So what excites you right now?
Well, I'd say the most honest answer I can give to what excites me is, easily my three daughters, Allegra, Amelia, and Alana, who are 11, 9, and 6. Every day is a blessing with them, but, I'm kind of sure you really want to be talking more on the professional side. Without wanting to narrow it down to just one thing, I would say it's the possibilities afforded by the digital age in which we're living. Not all that long ago, we were just another animal trying to make ends meet in the forest. For many millennium, humans grew our society through language, cities, agricultures, and the like. But life, generally speaking, was kind of the same, right? And, we were just kind of trying to cover some basic needs in Maslow's hierarchy and just kind of move up the triangle the best we could. For the last 50 years, the pace has changed dramatically. Like never before, we just see these realms of possibilities, be it healthcare or tech and tech-enabled services and the like, that at the same time are exhilarating, but at the same time, give us a little bit of, or at least give me a little bit of anxiety as whether we'll wind up using this power for the benefit of people and planet or to the detriment of them, right? So that's what really I'm focused on and excites me right now. I when I answer this question, I always think about that famous Chinese curse they used to say that Robert Kennedy made a little bit more famous when he said it in a speech. May he or she live in interesting times. To me, that's not a curse, right? It's exciting and it's a blessing, but it's one that we have to really be sure that we're doing the right things with it, because again, the power we have now has never before been witnessed, and it doesn't necessarily mean it ends well. We have to make sure that it does.
Absolutely. No truer words. So what's your advice for people investing in startups? What do you tell those investors to do before they write that check?
Sure. I think for where investors come in, just make sure you have a thesis and you stick to it, right? The idea of I invest in anything. Well, most people, at least myself, I know I can't, cannot properly look at diligence and support any company in any sector anywhere, right? So I think it has to do with really thinking about where you add value, and how you can be helpful to the investments you're going to make, because capital, as we know, is pretty abundant and a relative commodity. Real investors and the investors that people really want on their cap tables these days are the ones that are able to add value outside of just a check. And so I would say, that's number one. And number two, be patient, right? The best deals often come through relationships, and entrepreneurs you've met and developed relationships with over several years. I'm starting to see this in my own orbit as it's been 3 years now with Baird. And I finally feel like the deal flow is much more solid and relationship driven, right? I mean, anybody can have deal flow. Anybody's willing to send you deals. Anybody can find deals to invest in. But the real deals that and can feel comfortable about, that takes time. So I would say just don't rush into it and be opportunistic when you find those opportunities, but don't rush it, right? The best things take time.
Great. Then on the other side of that table, what's your advice for people running startups? What do you tell them to do before they go out to raise that first round of capital?
Yeah, I think it's a little of the same, kind of same, but different, right? In looking to be patient. And whereas an investor has to hone in on his thesis, right? An entrepreneur needs to really identify problems that are worth solving, that people really need, and that people are willing to pay for, right? And you do this by obsessing over getting clearer and clearer every day on what pain point they're solving, who needs the solution and why, and who the buyer is, and what she or he really wants and needs to see in their decision-making process. I think there's still all too many instances of great technology looking for a problem to solve. And especially in today's world, it's never been easier to start a startup, right? And so, right, just because you can doesn't mean you should. Take the time, think about it, and then once you're really sure, go for it and have the resolve to break through barriers and hear no 100 times and come back, again for the 101st, and you'll eventually hear a yes, right? When it comes to raising capital, when it comes to getting that first customer and the like. But if you start too hastily and go down a path, well, this could work, or I kind of feel like, when you get those hard times where you really need the resolve to push forward, it may not be there.
That's good advice. So let's talk about the state of startup investing. How do you see the industry evolving from here?
That's an interesting question, especially in these times. I mean, there's a lot of canned answers I could give you, from the availability of capital to the pandemic, being able to raise over Zoom and the like. But as the industry evolves, and I think we're going to see the pendulum swing back and forth on this quite a bit before we see the ultimate shakeout, it's still about relationships and the ability to find and connect with entrepreneurs doing great things. Right. So people that are good building relationships in person, typically are pretty good at that over Zoom as well. Right. It's not as if Zoom allows us to be different than who we are and do things differently and the like. So I do think it's that focus on relationships going forward. And again, to harken back to something we've already mentioned, especially in a world where capital is abundant and everyone's looking for kind of an angle or what makes them special or what is your unique selling proposition, be it as a company or as an individual or as an investor, right? The ability to really identify what you do well and play to your strengths, I think, is important. So we're going to see different models evolve, but I think those models will be able to coexist because it's going to be people and investors that have found a niche, found a way of doing business that works for them, and they do it successfully.
All right. And so what do you think is going to be the biggest change we'll see in, say, the next 12 months in this space?
So in this space, to just take a step back real quick, at Baird Capital, we typically invest in both healthcare as well as tech-enabled services. So when I talk about the space, I'm typically referring to those two. In healthcare, I think it's the application of the technology boom over the last couple decades. Because for the most part, if you look at 20 years ago, it cost $1 million or more and took forever to map a genome for the first time. Now you can get that done for $600, and if you wanted it done by the weekend, you'd probably have it done. Right? And so I do think, healthcare lags in the sense that a lot of this technology needed to be built first and then available for use in the healthcare sector. So I think when it comes to, genomics and, all types of big ideas in healthcare, we're only starting to scratch the surface of what the last 15, 20 years of, I would say, technology development will be able to do for patients and providers. I think on the other side, the speed at which technology companies are developing is the biggest change. It's both exciting, but also maddening. Is before you could raise rounds of capital with an idea, right, and a PowerPoint, build an MVP, take time to figure things out, right, come back for a little bit more, get lost along the way, find yourself in the light. And you still see that with companies. You still see companies successfully pivot and then find success. But now with all the tools available to entrepreneurs, the ability to bootstrap so cheaply, it's kind of up the expectation on what building a company looks like at the earlier stages. And so, I think that's one of the bigger changes we need to be, have our eyes open to, and also recognize the challenges of what that means for non-traditional founders. Because I do think the ability and the information and the accessibility gap might only be getting wider instead of smaller, despite the technology. And that's something we have to address, because we really think that we're going to get the best ideas and best technology and best everything for the world by taking 20% of the population, 15% of the population, and just listening to them. We're sadly mistaken.
Well, that's a good point. So let's talk about your investment thesis. What is it? And you talked about focusing on healthcare and tech enablement, but can you give us more detail about your criteria?
Sure. On the healthcare side, we'll invest in medical devices, life science tools, and digital health companies. I would say we're Series A, Series B investors, looking to write a $5 to $10 million initial check with 15 to 20 million reserves for a company over the investment life cycle. I'd say on the devices and tools side, we will go pre-revenue, because a lot of times most of the value, or a lot of the value at least, is accrued at the time of FDA approval for a lot of these companies. And therefore we need to be able to get in early and help them out. We do like to see large animal studies or first in human, right? In these cases. So we're still not investing in just science projects, but we will go pre-revenue and take on that regulatory risk. When it comes to digital health companies, which is the same as I would say our tech and tech-enabled services criteria, industry agnostic, is we look for companies with $1.5 million, 2 million ARR at a minimum. I would say our sweet spot is typically 2 to 10 million in ARR, with good customer track record, churn, and references. So, all the typical SaaS metrics, right? But definitely in that $1.5 million to 2 million ARR plus range.
Okay. Can you talk about one or two startups that fit that thesis? Maybe your portfolio?
Sure. I'll talk. We just invested in a company here in Houston, Ceranus. And, Ceranus is a med tech company that FDA approved and looking to raise a commercialization round. So in this case, it already did have FDA approval, but had, a great CEO, good team behind it, and a great technology. And we're just happy to be able to support that commercialization round, and looking for the company to really be successful over the next 12, 18, 24 months.
Great. I appreciate that. So you see a lot of startups and investors out there. What do you think is the challenge most startups face that you work with?
So I think the challenge is, we talked to many about expectations, competition, et cetera. I think that we also talked about the lack of, diversity. And so, I just think there's a lot of challenges around, those type of things, which are, what are the right expectations to have of a startup? Do you really understand your competition? A lot of times we hear that oh no, we really don't have any competitors. Or you look at everybody's got a magic quadrant slide where they're in the far upper right quadrant and everybody else is in the bottom left. And I think it just has to do with recognizing who you are and where you play and being true to yourself. Now, whether or not, I get these decks because I'm an investor. And so, I know there's a little bit of jockeying for position here and there and the like. So, I'm not going to just completely dismiss that angle. But as an entrepreneur, I think you just really need to be true to yourself and do a really good job of knowing who your customers are, who your competition is, and what your unique selling proposition is, or else you just kind of get lost in the noise and maybe even start to believe yourself that there's no competition or you're the only one and things like that. And that just knocks you off your game.
Absolutely. So, and then on the other side of that table, what's the challenge investors face in today's market?
I think it's just, again, identifying, building the relationships that allows you to get in on the best deals, or in our cases, we lead all of our deals, be on the front end and have the opportunity to lead a deal, write the term sheet, et cetera. Because there's just so much capital flying around, and looking just for a check is not enough. I mean, as investors, before, if you had money, you could play. Now that's not enough. Entrepreneurs are able to raise money from multiple sources and have gotten smart enough that they don't just want a check, they want support. So being able to just sell yourselves as investors, right, is important, which it may not have been. I haven't been in venture capital 15, 20 years ago, but again, I think 15, 20 years ago, if you had a check, you were a player. But now you just have to be able to say, no, what value do I bring to the company? And I think that's a major change. I think it's for the better, both for the companies, obviously, and for the investors, to make sure that they are investing in things that they really understand. But nevertheless, it's not as easy, I don't think, as it used to be to be an investor.
Absolutely. There's a lot of deals out there. Signal to noise can be hard to find sometimes. So my next question is, you see a lot of sectors and applications out there. If you had to pick one or two that you think are really good immediate opportunities for investors to pursue, say in the healthcare and tech-enabled space that you play in, what do you put at the top of the list today?
I would say on the healthcare side, if you're looking at devices and the like, we've seen a change over the past couple of years. So this isn't just recent, but before, a lot of the improvements were marginal improvements of technology, and it was easy to get things through the FDA, and you could have the blue vessel sealer and come back and get approval for a red vessel sealer, and charge 5 to 7% premium, and everybody was happy because the doctors had the relationships with the companies, and they would just buy the next gen product. I mean, I also don't want to make it sound as if it were really something as easy as a red stapler versus a blue stapler, but a lot of the improvements were marginal, but you were still able to sell them and make a hell of a business out of it, right? With the changes in healthcare and people looking for more value-based outcomes and the like, and the CFOs getting a lot more involved in the purchasing decision, where it used to be just the physicians and doctors, you really need to see more out of the medical devices and life science tools and the like that are being brought to market. So, I mean, there's two different pathways in healthcare. The one is a 510K pathway, which means, there's a predicate device on the market. And so you're kind of following another's technology in a way and saying same, but different. I have a little better angle on this. But then there is a PMA approval pathway, which are for kind of never tackled problems, or problems that are being tackled in a novel way. And as I outlined before, the 510K pathway, which is easy and people made a lot of money, that's kind of shut off these days. It's not as easy to make money on that. And frankly, the strategics, before they acquire a lot of the startups, are saying, well, if that's a 510K pathway, we want to see you commercialize that, right? Because we want to see that you can really sell that before we're willing to acquire the company. The PMAs are still different now. right? And a lot of them are the ones that are companies that can still get acquired at FDA approval and the like, because these are new opportunity areas. These are new revenue streams. These are potentially new markets for the strategic players to get involved in. And so therefore, there's a lot less waiting around because most of them, don't even have a competing product, right? And they can't say, well, they don't have the luxury of saying, well, I'll wait and see. So we see that in the healthcare side. Oddly enough, it's less risky as a startup to go after riskier propositions when it comes to solving problems via technology, again, because of the way things have changed. So I would say that's probably the big thing in healthcare. I would just say with tech-enabled services, I can't think of one thing where I would necessarily push. There's so much exciting stuff out there. I mean, everything from Web 3.0, you have blockchain, decentralized finance, just so many different markets that didn't even exist a couple of years ago. You can't possibly invest in all of them, and we clearly don't. But when I get excited about investment theses, I just think there's new markets that are on the cusp of being created. And so being able to learn about them and identify good investment opportunities, I think is key to success for any investor.
Great. Well, in the last few minutes that we have here, what else should we cover that we haven't?
But I can't think of anything in particular. Perhaps one thing that I think is a mistake that I see from a lot of entrepreneurs. So by the time they get to our Series A, Series B round stage, so for any entrepreneurs out there listening, hopefully this might help, is that it's great and everybody wants to become a unicorn. I think everybody should strive for that if the market can support it. But that doesn't necessarily mean unicorn valuations come quickly and easily. And it's also not an excuse to play fast and loose with capital early in the company's life cycle, because, we're shooting for $1 billion market. We're going to be $1 billion company. Therefore, it doesn't matter if we blow through 10, 15, $20 million, in a year or two as we get this company off the ground. Now, there are companies and teams that can pull that off for sure. The vast majority can't. And so I see a lot of entrepreneurs come and they say, well, we have this huge market opportunity. It's in this market and we're going to sell this company for $1 billion. And you have to tell them, well, yeah, I understand, but in this specific market segment, the average exit is $250 to $300 million, right? Not $1 billion, right? And so, that's fine. Hopefully you can be the unicorn. But at the same time, you need to build a company that investors are looking at and saying, all right, well, there's reasonable valuations and reasonable capital targets that I'm willing to put behind this company. And I see that a lot, right? And so I think, also being on the startup side myself with a lot of the other work I do, it's one of the things I caution our teams, just saying, hey, look, right? This is how you have to build a company that looks like this and feels like this and will likely sell in this range. If you wind up finding and hitting on something and you take that rocket ship to the moon, all the better. But I wouldn't have that as your singular focus and strategy right from the start.
Well, that's good advice. So how best for listeners to get back in touch with you?
Sure. Reach out at any time. Always excited about talking to about new companies, new entrepreneurs. I would say the best way is tmarx, Marx at rwbaird.com. And I'm sure you're going to include in the show notes a couple other pathways to get to me. So happy to talk.
Great. We'll put that in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Thank you all. Look forward to speaking again.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Halty Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.